markets falling off even further from these levels, given given the fact that we may not necessarily see the kind of big bang reforms, whatever that means, that investors are hoping for, or at least the government following through in terms of execution? So one is, of course, the local piece, and then, of course, global factors where growth concerns are clearly justified. Whether or not China slows down significantly from these levels is another matter altogether, and whether the Fed acts in October or December. So you've got, other global factors to contend with. But do you see further significant correction from these levels? And would corrections really be the opportunity to review your position as far as the market is concerned and re-enter sectors where you perhaps were not?
No, exactly. See, I think markets can correct tomorrow if people realize, let's say by November, December, that the Chinese PMIs are not stabilizing. As you go and meet Chinese companies, which is what the sense we got our last couple of months.
What are they telling you today?
No, things are drifting down. So that's really
is it far worse than the number that the growth number that the government holds up?
Yeah, obviously that number is much lower than the official number which comes out. But then again,
so what, 5.5%?
Our point was 5% number is not bad for 11 trillion economy.
Yeah.
I mean, what we look at China is, you've got a good China, which is what we all invest in, the healthcare sector, the internet sector, the clean energy, the insurance in the China. And then there's a bad China, which is the overcapacity in steel, cement, coal resources, etc. The problem is people are fearing that bad China is going to overwhelm the good China, or the tail risk arising in China. So which is where it's important that somewhere the economy finds a flow, things are okay. From a leadership perspective, they do the right thing. So rather than intervening in stock markets, what you want to see is, again, more of these SOE reforms, more of higher dividend payouts from the likes of SOEs like China Mobile, etc., more buybacks, etc. So improved capital allocation. China's got a lot of room on fiscal deficit to up the kind of the spends. Fiscal deficit for this year is going to be 2.5% of GDP. So that number can easily go to 4.5%. So you want the government in China to do the right things. And once that happens, then people are going to be okay. People will reconcile to the fact that as long as I have a portfolio which is kind of conducive for a 4% growth in China, I'm happy with that. And then I do my stock picking. But if the stabilization doesn't happen, then people remain very fearful, which is what happened in the month of August. Then you have large-scale redemptions for the EM funds, and that's where you can see India down another anywhere 5 to 7% easily.
So would China be the biggest risk then, even as far as India is concerned?
Yeah, clearly. I think stabilization of China is very important, because if you look at what's happened in the world over the last 7 years, US being a demand driver, but outside that it's been largely China which has been the key demand driver. So the world today faces an issue of demand. Money is not an issue, which is why I said if the Indian leadership does the right thing, money is going to queue up to come. But in a period of dollar strength, things don't come in on a platter. So China is the biggest risk for the region, and I think the Chinese leadership realizes that. So what you want is, again, the right policy making, the right steps, which are in line with the slower but a more stable growth.
So what are people telling you at this point in time in terms of real expectations from the government, in terms of actually getting stuff done? There are concerns on, there's too many mission mode sort of stuff that's going on at this point in time and not enough follow-through action. What is the sense that you get?
I think if you look at what's happening in terms of positively in the economy, it's clearly the work on roads, which is where you look at what's happened in terms of tendering, what's happening in terms of order books for companies. That's something positive. Railways is clearly positive, again, but still very early days for railways, very, very early days. You will get impact of all this next year. And then outside that, defense, we've talked again, the real economic impact will be somewhere second half of next year. So, see, what's happened is the private sector confidence is shaken. Again, if you look at the semi-urban areas, monsoons being bad, you've seen crop prices being down. So the inherent demand in the economy is weak.
So you're pushing back earnings revival to now what? Next year?
Yeah, it goes to next year. So which is where somewhere government's got to pick up the slack and do this initial round of whatever, capital expenditure, so that you build a virtuous cycle in that. Because whatever we may say, we may be a strong demographic story, a strong domestic story, but we are linked with the world. So if the crop prices are down in Brazil, Russia, they're down in India, and somewhere it impacts. So I think that's really the problem, which is where we're not really seeing demand revival. So you meet all these consumer staple companies also. Last quarter was all about margin expansion, which came through largely raw material price correction. Gross margin expanded, but you talk to them about volume growth, it's very patchy. So I think that's really the risk for the markets, that volume growth is patchy, demand revival is slow, valuations are high. So the government needs to keep doing the right thing so that people keep giving India the benefit of doubt, saying, okay, things would happen in the next 2-3 years. If you see disappointments from a policy front also, like GST not being passed, Parliament not functioning, then people say that why am I paying these valuations for slowing growth in India? So, and then again, not everybody looks at things in a kind of a granular way, like the way we are discussing. So people look at this headlines, okay, land acquisition is not passed,
GST not
passed, that's the end of the story. And then we go back to these guys. Look guys, land acquisition was not passed, but post that, Foxconn announced that they'll put $5 billion in Maharashtra. You look at the ads which come from Odisha. They say that they've got 40,000 hectares, which can be taken.
And state governments are sitting on large tracts of land at this point in time.
That's the positive of the story. So like this roadshow which I'm going, which is 2 weeks again in US, in South America, is largely telling investors about this, that India is a good story. It's not isolated. So tomorrow if anything happens...
So what are going to be the key points of your sales pitch to investors in the US about India?
No, I think this is something that today what we live in is a world where there is very limited secular demand growth opportunities, and that's where India benefits with good demographics, low consumer debt, a stable government in place who knows what it's doing. So the only kind of a negative is that you will say growth recovery is slow, so you need valuations on your side to buy into the market, but would be...
So the correction is a good thing as far as you're concerned.
So we always tell our investors to add to the India exposure on dips, and at the same time we tell the policymakers not to feel complacent about the fact just because China has got its own set of issues, don't bask in that glory, because there is enough to be done. See, we've not done anything for last 15 years. We've got to do a lot of catch up. This is where these hopes are. And to be fair to China, see, we talked a lot about the bad China, but the week before I was in China, meeting a lot of these internet companies in China, and there's a lot of good work which is happening by the likes of Baidu, Alibaba, Tencent, etc. So you look at offline to online, which is happening, technology. Clearly these guys are focusing on productivity. So I think probably next 2-3 years can be challenging, but China can be a serious contender 5 years from now. So
what about the government's disinvestment program? And of course it's been held up for because of the volatility in the markets. They haven't moved fast enough in terms of decision making, but they claim that they have a pipeline of 50,000 crore rupees which is ready, and it's a question now of timing, and I guess that's what they're looking at this point in time. But the government disinvestment agenda, as well as a couple of big IPOs lined up for this year, Indigo, Cafe Coffee Day and so on and so forth. Your take on...
No, I think some of these IPOs are interesting. So some of these IPOs are interesting. Some of these IPOs we've seen, we met the management are coming around, and clearly we would look at them. In terms of the government investment agenda, if you look at ONGC, Coal India, I doubt in this environment where commodities are under pressure, where you're going to see a large scale queue up for these kind of businesses. So I guess
largely be left to poor LIC, is it?
Whatever. I think if the dividend yield is very attractive, some people may chip in, but they're not as attractive as pure secular domestic demand stories. So that's really there. And outside that, the public sector banks, I think people would wait for more clarity on the managements there, whether the culture is really changing, whether the governments would stop intervening, and then what is the true kind of a sense of NPAs, because you've had estimates that these NPAs are anywhere between 5 to 20%. So though we talk of the Chinese banks in NPAs, let's not forget that there's a problem in our backyard, and we've got to solve that.
So what would be the top sectors and what would be the most vulnerable sectors at this point in time, according to you?
I think the top sectors, again, would be, let's say, and I'm taking valuations in mind, so private sector banks is something we still like, and we'll be looking to add to them at every depth. IT looks interesting purely from a kind of a moderate return perspective, 10 to 15% dollar return, we can get that. Pharmaceuticals, no upside from a valuation perspective, but in this market things can correct 15% very quickly. One would look at that, so that's interesting. And again, industrials look interesting. So businesses which are strong moats, where we believe that limited competition would be from the Chinese or the Koreans. I think those businesses would be something one would look for.
And most vulnerable?
I think vulnerable would be, again, some of these resources names, because I think this down cycle is longer to stay.
The commodities?
The commodities. So clearly you don't know when would they give up, and just say we can't pay the bank loans.
We haven't seen the bottom yet.
No, we haven't seen the bottom. You've got to see guys bleed over there. You've got to see guys put their capacity of sale. That's not happened.
Well, Rahul, it's been a pleasure speaking with you. We wish you the very best of luck as you make the India pitch to investors in the US. And we will check in with you for the feedback once your trip is over. But thanks very much for joining us on CNBC TV 18.
Thanks, Shireen, for having me. Always good talking to you guys.
Thank you so much. With that, it's time for us to wrap up the India pitch from all of us here. Goodbye. Many thanks for watching.